Hello everyone, this is Matthew Fraley with BreakpointTrades.com. First off, hope everyone had a wonderful weekend. As you know, it is Super Bowl weekend, and this is my Super Bowl weekend technical analysis review of the stock markets. And got a lot to cover here today. Going to try to get through this quickly so you guys have time to watch the Super Bowl, and including myself. There's a lot to cover here. First off, precious metals, gold hit a high of 29.10 last week. Remember, early last year, I gave a prediction of a target of at least $3,000, and so gold was shy of $90 within that $3,000 area. While it is a little overbought short term, I do believe that 3,000 psychological number will be hit fairly soon. That's one thing you'll learn about the markets. When things get close to those psychological round numbers, you almost always tag them. But really nice move out of this coil pattern. And as far as the general market, again, it's been a wild action the last 3 weeks with China DeepSeek AI, Trump tariffs, tit and tat back and forth, earnings season, etc. You can see here on the triple Qs, you got a very obvious coil pattern forming. Yes, we formed another lower high last week, but we're in the midst of a coil. The price simply rallied up to the coil before pulling back. The S&P 500 bounced off support a week ago, this extended trend line, but still have a series of lower highs here. On Friday, it stalled at that supply zone. The bullish view is you have an ABC zigzag of some sort, or it can be more complex, and there's also bearish options as well. Again, I'm Matthew Fraley, founder of BreakpointTrades.com. I opened BreakpointTrades.com in 2003, 21 years ago, to provide the best technical analysis on the planet, amazing trade ideas, newsletters, awesome mechanical trading systems, which is my personal passion. You should consider subscribing, or at the very least, sign up for our free newsletter, as you'll get alerts. But honestly, add a subscription, then you'll get access to our systems and weekly, 5-6 weekly newsletters, dozens of actionable trade ideas, system trades, etc., instead of just these free YouTube videos. Okay, let's get back at it. So again, happy Super Bowl weekend, everyone. This newsletter is divided into 9 major sections. These weekend newsletters tend to be quite comprehensive. They're not for the TikTokers who have 1-minute short attention spans. These are made for folks who really want to dive into the charts, into technical analysis, learn, and that's what we do. I don't shorten these newsletters just to get a bigger audience. So I know the length of these newsletters can be a turnoff for some people, but again, I put out the best content I can. I don't try to shorten it down, just to make it shorter. Okay, but anyway, weekend newsletters, we cover everything from the general market indexes, sectors, technical indicators, commodities, precious metals, US dollar, crypto, and trade ideas. Again, just to recap, like I said, it's been a wild last 3 weeks in the market. First off with that Chinese AI DeepSeek, which caused an initial sell-off in the market before recovering. Then tit for tat tariffs with Trump between Mexico and Canada, which got put off for a month. But then you got China there, you got USAID cuts to that. You have all these stock earnings. You have FOMC last week, jobs report. So a lot of stuff here pushing the market all around. Quite a bit of volatility. Right. For the week, the major indexes closed down on average 0.35%. Now the Nasdaq 100 bucked the trend a little bit. It closed just slightly higher. Also, the 21 market sectors we follow, they were almost evenly 50% up, 50% down. All right. Now, the Nasdaq 100 made a lower high last week, but it's in a very obvious coil pattern, as I'll show you below on the 2-hour and daily charts. The S&P 500 either completed a simple zigzag, that's an ABC pattern, and that'll eventually result in new highs under a bullish scenario. It could also be a more complex correction. The bearish view would be a nested 1-2, 1-2, but for now, until major supports are lost, we'll still give it to the bulls. Now there is a few timing high cycles that were hit last week, and I'm not great at predicting timing cycles. I usually refer to others for that, but that's something to be aware of. So, we're having a logical pullback as of Friday. Now, precious metals, gold, as you know, 1 year ago, I made a prediction about gold hitting 3,000 bucks an ounce. Well, almost got there. Last week hit a high of 29.10. That's only $90 shy of the $3,000 psychological round number. When you trade markets long enough, they like to hit those round numbers just like they like to fill gaps. Okay, it's kind of like a stock going to $95. It almost always goes to 100. Same thing here. So even though there's some negative divergence here, I could see on the weeklies developing, on the MACD and RSI, and even on the daily we're a bit overbought. I still think that $3,000 will be tagged sometime soon. Now next week, news items, CPI, PPI inflation data on Tuesday and Wednesday are the big one. And of course, any potential Trump tweet out of the blue that could stir the pot. Now, some macro trends I'm keeping an eye on for this year. So I'm expecting a big move in silver over time, $50 to $70. Gold over 3,000. The DBC SPY commodity ratio has underperformed since 2011. So eventually we're going to see a macro change there where, it's been best for all these years to be overweight S&P, underweight EEM, emerging markets, but that'll eventually change, and I think we'll eventually see a flip there. So platinum is very undervalued relative to gold. I think that's an easy double over time. I like the energy market, and I still am expecting an eventual recession in the stock market. Again, all politics aside, just because that yield curve, remember, was the inverted the longest in history, and that's always been the best predictor of future inflation. So I think it's coming eventually regardless. Trump will have to deal with it. Okay. All right, let's move on. So first image below, item number 2. This is kind of a little fun image here. Here I put some images of the Super Bowl. Here's one in a little AI image generated of stock floor traders on Wall Street watching the Super Bowl, whatever. AI is kind of fun to generate these little images, but otherwise, like I said, before we get into we'll get into all these charts eventually, but like I said, you can see on the S&P 500 on the upper left, the daily, this obvious ABC zigzag so far. We rallied off that support trend line last Monday. On Friday last week, we pulled back with a lower high off that supply zone. Okay, here's the 60-minute view. This ABC potentially could be a bearish thing as well, but we'll give the bulls the benefit for the now. The line in the sand to me would be that 59.23 low. For the bulls, you really don't want to go below that. All right. And on the Nasdaq, you can see a very obvious coil pattern. On Friday, we stalled right at the top of that coil. As you would expect, that was a good area to take profits if you're long triple Qs, or take a hedge there, or take a short. All right. And let's move on. Item number 4 shows the index sector table, what transpired last week and on Friday. Again, Friday, all the index, or for the week, everything was down for the indexes except for the Nasdaq 100. Barely closed higher. Friday had a nice pullback on the markets, as you can see, down anywhere from 1.3 to 1%. As far as the 21 market sectors, like I said, pretty 50-50 mix of up and down here. All right. So, and moving on, currencies. US dollar was rallied on Friday, but still down for the week. Cryptocurrency still down for the week. It's been lagging relative to the market for quite a while, but basically down about 1% for the week. Commodities, DB index up 0.5% for the week. Now, that's despite crude oil losing 2.8% for the week. That said, crude oil is down into a demand zone, so we'll see if it can find support there. Big rally in natural gas up 8%. Copper up 7.6%. And I'm going to show some trade ideas in that area further below in the commodity section. Uranium was up for the week. Big wheat for wheat up 3.4%. Coffee up 9.3%. My God, guys, this move in coffee is just unreal. And we'll get to those charts further on. Precious metals, like I said, gold hit a new all-time high last week, just 90 points shy of 3,000. It closed at 28.87. Silver was up 1.8% for the week, about $32.50. And GDX, the miners, up 4.9%. So they're still leading, though both of these had a DeMark 9 on their daily, so they're pulling back a little bit on Friday. And as far as the bond market here, nice pullback in the 10-year, 30-year Treasury yields for the week. They were up on Friday, though. Here's the yield curve. It's at 1.05. Next, Item number 5 shows the economic news count. Again, we got various economic news here, but the big ones are the CPI, PPI, inflation data on Tuesday and Wednesday, respectively. Okay, let's go and jump to things. And remember, we still have some stock earnings, though I'd say most of the big cap stocks, S&P 500 companies, have already reported. And it's kind of been a mixed bag. So let's take a look at some of those. So chart number 6 here is Google. Some of these big cap tech stocks have gotten hit. There's some that have quite strong like Meta, but here's Google. So here's its earnings reaction last week. Nice gap down. Had a nice negative divergence going into earnings. Chart number 7, here's Tesla. It hasn't reacted well at earnings as well. Plus, they have lower sales. They've been declining. But anyway, there is a little demand zone down here. We'll see if it can find some support into there or not. But it continues to weaken. Chart number 8, here's Microsoft. So it also had a negative reaction on earnings. It's now down to kind of a little shelf supply zone, kind of a weak area. We'll see if this can hold or not. And here's Amazon. This reported last week. It was trading up into earnings before selling off after earnings on Friday. And the final one that's actually holding up well in the big cap tech stock is Meta. So Meta had a very obvious coil pattern, rallied up into earnings, and then continued. That said, I think you got aggressive short here. Notice the black candle doji candlestick on Friday. So you could theoretically use this as a very tight short. Your trigger would be 1 penny below Friday's lows. So your trigger would essentially be 711, 70 or something. And then you'd put an immediate stop at the high at 725. You do have some divergence on the CCI, but on a 60-minute chart, you have some MACD divergence. So that's a potential mean reversion short, at least for a move back to the 90 MA, if you want an aggressive short. But again, these need to trigger. You need to get a move below the low of that doji. All right, let's go ahead and move to the major indexes. So that reviews some of the earnings on the stocks. Chart number 11, here's the weekly view of the major indexes. Again, chopping around here. The Dow's been the strongest lately, finally pulling back late Friday. But you could see the sideways action here on the S&P and Nasdaq. And the Russell's been lagging quite a bit, of course. Still has that nice lower high there. Next, chart number 2012, here's the daily view of those same indexes. Again, you can see this sideways action here. Essentially, look at the Nasdaq 100. It's been sideways here since basically mid-December, right? So quite a bit of choppy action here. We'll see if the bulls can hold on to here. Moving on to the individual indexes. Here's the Dow Jones. Don't show it too often. It's 30 stocks, as you know. But you can see Dow rallied off that demand zone in early January with that divergent low. And so far, it's pulling back off the upper supply zone. Again, it's still above its 20-day and 90 MA, and 50-day. Well, it's actually below its 90 MA, but it's above its 20 and 50. So we'll see if those areas can act as support. Again, logical area to pull back off that double top supply zone, but we'll see if this can form a higher low in these areas. Moving on to the S&P 500, chart number 14, here's the S&P 500. This is the big picture chart going back to the early 90s. So it kind of shows you the big bull and bear markets. Okay, we've been in a secular bull market since the March 2009 low. You can draw a very obvious uptrend channel. This is a great chart for long-term folks, very long-term folks, not traders, but guys who really don't want to ever do a trade except very, very rarely. Kind of like a paint dry. This 60 stochastic this 14 monthly stochastic is a great thing. As long as it stays above 50%, you're in a bull market. When it falls below 50%, that typically signals your bear markets, like the late 2000 to 2002 bear market, the 2008 crash, 2022, etc. Another thing, guys, people are looking for the end of this bull market. Now, again, this secular bull market has been going on now for 16 years almost. But if you look at the MACD action, usually secular bull markets end, or at least right around when the monthly MACD flattens out, or at least a bear market, maybe not the end of a secular bull. But, the point is we are quite stretched here. But look at the MACD action. There's nowhere close to crossing. So that's why I think any decent correction in the market will be some sort of big fourth wave, not the end of a bull market at this point. Next, chart number 15. Here's another monthly chart. This shows you two monthly moving averages that are effective, the 8 and 13 EMA. Those are both fib numbers. Again, I'm not a big fan of moving average cross for systems, but these have been very effective, catching the longer term trends, keeping you out of big bear markets like 2008, 2001 to early 2003, and even the 2002. That said, you can see the areas I've marked with the shaded green. So these are getting a bit stretched. Eventually these maybe need to flatten out a bit. All right. And lastly, chart number 16, here's my monthly BPT 401k paint dry system. Okay, so again, it's like watching paint dry. It's a monthly chart. Trades can be held for years at a time, but it's very effective about keeping you out of bear markets, like 2008, 2000 to late 2002, etc. This system here goes back to the 1960s. I also have it on the Dow Jones going back to the 1920s. It's very effective. Again, it's like watching paint dry, but no changes here. You can see it got out last in 2022, but then got back in January 2023, and it's been long since. One thing to note here, and I'll maybe do a separate video on this, is this squeeze indicator. It's quite effective. So whenever you see the dot here, that usually signals big moves. And you can see all these, every time you got it on the squeeze indicator, started these big monster moves. You can see it in 2023, started that big uptrend. You can see it there in 2020. You can see it in the bear markets too, like early 2008 you had it and you had a big crash. You'd see it in 2000. Very effective. Basically the squeeze indicator is, the squeeze occurs whenever the Bollinger Bands is inside the Keltner Bands. So it's kind of a rare event, but it precedes pretty good moves. So pretty cool indicator, but otherwise, again, this is our paint dry system. Next, chart number 17, here is a weekly view of the S&P. So standard chart. So again, for the week, down 0.25%. Could see, continue to find support on this broken little channel line inside the larger uptrend channel. So no changes here overall on the weekly. Chart number 18, here's another weekly chart. This shows you that when we eventually do form a high here, again, whether we go to make a new high still, or we've already formed a high, we're eventually looking for a major wave 4 correction. Like I said earlier with the monthly S&P charts, when the MACD is like that, you don't end bull markets like that. But we could eventually have a pretty deep wave 4 correction, and we're talking about 500 to 900 points. Like I said, if we make a new high here, I would view wave 3 of 5 shifting over to here. But it's something to monitor. Sometime this year, we're going to see something like that, guys. So just be aware of that. Okay. That'll produce a buying opportunity, but you want to be careful of that. You don't want to be super long on all the indexes and stocks that follow the indexes on a wave 4 correction, because as I'm telling you, it could be 500 to 900 S&P points, and that's pretty tough to sit through. Next, chart number 19, here, moving back to systems, here's our weekly KISS systems. Now these are kind of like paint dry systems. They're based on the weekly KISS. They can hold for years at a time as well. No changes here. They've all been long since 2023, stuff like that. So no changes. Next, chart number 20, here's the daily S&P 500 KISS system. No changes here either. So little choppy action here lately. The system's had really monster trades catching the uptrends from late 2022 all the way into December of last year. Then a little whipsaw trade, which would be expected, after some major trades. And it's currently long right now with a wide stop. Moving average ribbon is still bullishly stacked for now. Next, chart number 21, here's the 4 time frames. First with the cycle indicators, the ribbon, and the DeMark. So first off, here's the daily on the upper left. We've been struggling at that resistance cycle now for the last month. It's been a pretty good indicator there. Here's the half-day chart. So after that DeMark 13 a couple weeks ago, we pulled back. ABC action so far. We're below the ATR. 130-minute chart. We're above the ATR, but we're pulling back from that resistance cycle and from the ATR on the 78-minute. So a lot of choppy action here recently. Next, moving on to the standard chart. So chart number 22, here's a clean S&P 500 daily chart. So again, back in early December, that's when the S&P topped. Then we had that correction, filled the gap, bounced off the demand zone. Okay, then rallied, broke the downtrend channel, made a new high at 61.28. And since then, we have three obvious waves here. Now, the bullish view would be an A, B, C. Okay, notice how last week's low on Monday bounced perfectly off that extended trend line, just perfectly. So that would be the bullish case. We completed an ABC. Now, you can see we rallied all the way back to supply zone, sold off again pretty hard from there on Friday. The S&P down 58 points. Pulled back from the supply zone a couple weeks ago as well. So those are very effective areas to watch, the supply and demand zones. Now, if this is an ABC, this should ultimately form a higher low. Okay, your line in the sand for the bulls is right here. You really don't want price to go and take out the low of last Monday. So we'll see if we can form a higher low in here. There's other options. The really bearish option would be a nested 1, 2, 1, 2, but I'll give it for the bulls for now. Chart 23, here's a half-day chart. Again, remember we were talking about this. We're looking for a wave 5 high with that pullback into early January being a wave 4. At that time, we were talking about this being the line in the sand. I shifted it up to here. Here you can see this expanded megaphone pattern right now. So if this can form a higher low and rally again, I would look for a new high in a wave 5. Next, chart 24, here's a 60-minute view. Again, just showing you a closer view. You can see the 5 waves up here to 61.28 so far. ABC pullback. Again, under a bullish view, that would be an ABC of wave 2. This would be a wave 1 of 5. Again, it could be more complex, or you can have a more bearish thing here. Here's a little demand zone we pulled into on Friday. We'll see if that can hold. And chart 25, here's a 15-minute view of the S&P. So you can see the rally up on Friday into a supply zone here. And we've pulled now back into a demand zone. And here I added some fibs on the side. So for the bullish case, really like to see it hold into this area. But we'll see. I do worry about some of the government stuff going on. And I don't want to get political here at all. Okay. But I do think some of that could eventually, the Doge and stuff like that could eventually result in maybe recessions. Let's be honest. The government is the biggest employer, and if you take away too much money, well, it's going to have effects. But that's going to take time to result in the economy. But again, like I said, I'm still predicting we have a recession down the road. But anyway, that has nothing to do with this 15-minute chart. I'm just rambling a bit. Next, chart 26. Here's the Nasdaq. Triple Q's KISS system. So this has been choppy lately. It went back long last week finally. STS stop is 505. Chart 27, here's the 4 time frames. Again, very similar to look to the S&P. Kind of choppy here. I'm not going to, just to save time, we're going to skip this. Chart 28, here's the daily Triple Q's. Again, obvious coil pattern here. You can see on Friday we tagged the top of that coil. That was an area we've been pointing out the coil. So those of you who've been watching, that would have been a good area to take profits or take a little short or a hedge. Alternate view, for now we view that last high as a wave 3, that low 49.99.70 as a wave 4. Eventually we break to a 5. The alternate view would be we formed a wave 5 back here in December. And chart 29, here's the 2-hour view, just showing the obvious coil pattern. You can see how we stopped at it perfectly on Friday. And here's the 2-hour view showing that, another 2-hour chart showing that perfect coil pattern. So we'll see, guys. Again, really, if you're long the Qs, again, it would have been best to take a short or a hedge up there at the test of the downtrend line on Friday. But if you're long, you're right in the middle of the range now. A stop could likely be below this uptrend line. And finally, chart 31, here's the Russell. They're pulling back here. You can see it's been stalling around this area and still unable to really get going. Here I added a lower uptrend line to monitor as well. Obviously, that buy around the test around the 200-day moving average in January, that was a good buy opportunity. But right now, it's kind of in no man's land. And chart 32, here's the 2-hour view. Seen pulling back from supply a couple times last week. Bullish view is you had an ABC pullback, but we'll see. All right, that does it for the major indexes. Let's move on. Chart 33, here's the VIX. So the VIX has also been chopping around here. The one thing I will say, the Bollinger Bands are pinching on the VIX. So, that could be pointing out to some pretty volatile or violent moves in the S&P coming soon, so just be aware of that. Driver 34, here's a 60-minute view of the VIX. We like to show this. VIX loves to fill these gaps. There's a big unfilled open gap down here where if the market rallied to a new high, maybe that could be filled. But otherwise, last Friday, you can see it rallied off that demand zone. Now there's a supply zone just above. Okay. Moving on, let's look at a review a few sectors. Chart 35, here's XLK Technology. Been chopping around here after making that new high. You can see last week's high stalled right at that 61.8 fib retracement. Chart 36, here's semiconductors. They've been very choppy here as well. You got kind of an expanded megaphone pattern here. So far, they've held this demand zone, but you can see on Friday they're pulling back from all these moving averages. You got them all bunched up there, the 200-day, the 20-day, the 50-day. Okay, so onus is on the bulls here. Chart 37, here's IYT Transports. After that break of the uptrend channel back in December, nice sell off to the 200-day, which held lower high, pulled back. Now it's bounced a little bit. Kind of choppy here. Chart 38, here's XBI Biotech. So far, rallied up, stalled at the 200-day moving average here. Chart 39, financials, XLF. Both financials and banks have been quite strong. You can see these did make a minor new high on Friday before pulling back. You do have a little RSI divergence here. These are quite overbought, but clearly nice rally off those demand zones and divergent lows in this January. Chart 40 here is materials. Still in the same pattern here. Again, nice rally off the demand zone in early January, but unable to break up above this pattern for now. The volume patterns are still okay here, but I like to see it holding here. Chart 41, XLP Consumer Staples. Nice rally off the demand zone. Been chopping around here. You could see the pullback last week off the 61.8 fib. Chart 42, Utilities. Recently pulled back off the supply zone. Right now it's kind of in a coiling action. Chart 43, XLV Healthcare. Remember, nice rally out of the channel, but logical pullback so far late last week off this supply zone. You have the 200-day moving average here, and you have the 20-day below. And energy has been quite volatile here. So here's XLE Energy. Energy has been very volatile since November. It was up at the upper end of the range. V sell-off into December. V rally into January into the supply zone. Pullback. And very choppy. It did recently bounce off the 61.8 fib. So let's see if it can hold that area. I'm bullish energy for the year, but right now it's pretty choppy here. And chart 45, here's a cleaner view of the chart, but shows you the same thing. We're still holding that 61.8 fib, but that was a pretty ugly candle last Thursday. Chart 46, here's Oil Services, OIH. Again, they pulled up off the supply zone a few weeks back. So far you got a higher low here, but we'll see if that can occur. And some macro trends I'm keeping up is the EEM, emerging markets. So here's the EEM SPY ratio. So as you can see, this ratio has been downtrending since 2010, 2011. That means, on a portfolio, it's been better to be overweight the S&P 500 over EEM. If you held EEM in your portfolio, like a 401k, something like that, or IRA. But eventually trends change, so this is something I'll be watching eventually for a macro change. This special K indicator down here is pretty reliable when it crosses the black crosses the red. You got a great sell signal there in 2011. And I'm watching this for an eventual buy signal. When this gives a buy signal, when it crosses over the red, it then will be time to maybe shift that and go more overweight EEM over SPY. And here's the same chart, but it's a nice clean Renko chart, really clean. I'm using a 9 EMA. I'm using a 0.1 box size for the Renko and parabolic SAR. So pretty nice clean chart as well. But again, there's been no technical triggers at this point. Moving on to commodities, chart 49, DBC. This is the commodity index. Here's the breakdown, by the way, of the various commodities. Pretty heavily into energy, around 40% or so. You got precious metals and various agriculture stuff. But you also have some treasury bonds, which is interesting. But anyway, up a 0.5% last week. Overall, this has been consolidating sideways for the last year and a half. When it eventually breaks out of this range, though, I think we're going to have a monster move in commodities. So that's why I'm predicting a macro change sometime this year. Chart 50, here's the daily DBC. Again, back in mid-January, pull back off that resistance zone logically. But you got a higher low here so far. Could be kind of forming it's not really a cup and handle, but it could be forming a higher low here to eventually break out of that. And chart 51, here's the DBC SPY ratio. Again, same deal. It's been better to be overweight SPY over commodities generally, but I am monitoring this wedge, which did break out in January, pull back, but I'm looking for that higher low, which I show here on the dotted line. So if we see a rally in this ratio, commodities could really start outperforming. Next, chart 52, here's crude oil, weekly view, down 2% for the week. Still in this overall kind of wedge weekly pattern. Chart 53, here's the daily. This is what I'm more interested in. So nice pullback a few weeks back from the supply zone. We're now back into a demand zone. So we'll see if it starts finding support here. Chart 54, here's UNG natural gas. Nice rally about a week and a half ago off that 50-day moving average, higher low. Right now it's chopping around. Chart 55, here's copper. Big rally last week, up 7.25%. So look at that move out of that coil. And here's the daily chart. So we held that demand zone, broke this downtrend line, pulled back, had a higher low. You could see you had your moving average ribbon pinching. Everything was set up there. This actually looks really good, guys. There's various copper ETFs, CPER. There's some other ones. Also, I would keep an eye on some stocks. Here's FCX. There's other various copper stocks. It's been a downtrend channel here, but notice you got a nice MACD divergence at that low. Here testing the downtrend channel last week. So I would keep an eye on these areas. Next, chart 58, DBA agriculture. This area has been quite strong all last year. Remember, recently broke out of this coil pattern. Here's the weekly view. Now it's down slightly for the week, but last January I was talking about this cup and handle, which is obviously more than played out. Chart 60, here's wheat. Wheat I've been talking about recently, breaking out of a nice rounded base. Looks pretty good. None of these are good for inflationary, especially at the store, grocery store. Here's coffee, weekly view, up 5%. I mean, it's going absolutely parabolic. You had an absolute technical double bottom back here in 2023. And my God, it's been off to the races. So you coffee drinkers, this is going to be a problem. And there's no MACD divergence. It is quite overbought, though. Here's the 45-year chart going back to 1980. Like I said, absolutely destroying those previous highs, which were around $3, $3.10 range. I mean, exceeding them by 33%. Not good for inflation. Next, moving on to the bond market, chart 63. Here's the 10-year Treasury yield. Nice pullback so far for the last several weeks. Here, bouncing a little bit on Friday. Chart 64. Here's high yield corporate bonds. This is the weekly chart. Now, market tends to follow this, and this has been very strong. There is a little weekly divergence here to monitor. It's not a sell signal right now, but just something to be aware of. Chart 65. Here's HYG on the daily. So nice pullback here last couple days, but it's still in a very strong uptrend. Moving on, chart 66, Bitcoin. Here's the weekly view. Again, Bitcoin's had a hell of a rally since that late 2022 low. Steve and I were showing a falling wedge, 5-wave pattern. Man, I bought some Bitcoin there, but I really should have loaded up, quite honestly. It's 100,000 recently, 109,000. But my problem with it now is you have 5 waves up. Doesn't mean it can't go and make another high here, but you're in the ending, or you're at the end or toward the end of this 5-wave pattern. So the risk reward about going long a bunch of Bitcoin now isn't good. This is going to be due for a decent ABC correction. Next, chart 67. Here's the daily. Again, very choppy here. It's been holding that demand zone, but it's down a little bit here this weekend. And guys, I just want to tell you, cryptocurrencies are not a hedge for the market. People think they're, it's a protection for the market, but they're not, and they're more volatile. So here's Ethereum, especially some of these other ones. So Ethereum, just think about this. It's had a 50% correction from the December highs to, about a week ago when it fell from 4,100 to 2,135. I mean, I don't know about you, but I can't handle a 50% haircut in something I'm holding. I wouldn't. That's just saying. Cryptocurrencies, they can have crazy moves. They're almost like stock options or futures, but they're not hedges for the market. Now here's one crypto stock we've been showing, WGMI, Bitcoin Miners ETF. Now it has been holding this 200-day moving average. If you took a shot there, still looks okay. Moving on to currencies, Charber 70, US dollar down 0.3% for the week. You can see it's pulled back once again off that supply zone. Charber 71, here's the daily chart. Kind of these expanded lines here. Now, if it can lose this, that would be positive for a further decline in the dollar, help precious metals as well. Charber 72, here's the Japanese yen. Been talking about this being a low risk buy, and so far it's rallied nicely off that double bottom demand zone. Let's move on to precious metals. Charber 73, gold. So gold up 1.9% for the week. Hit a high of $29.10 before pulling back. So only $90 away from that big $3,000 round number. Okay. Round numbers love to be tagged. So I think that's likely going to be tagged on this move. Again, I am concerned a little bit on these divergences. You can see it on the RSI, on the MACD. Divergences are not a sell signal on their own. But I think at minimum we'll tag that 3,000 sometime just because it's close. But look at this beautiful rally out of this base. And again, a year ago I was calling for a big rally into precious metals. That was one of my macro calls. Next, Charber 74. Here's the daily view of gold. Again, beautiful move out of this ABCDE coil. Okay, beautiful move there. So it is a little overbought here short term. You can see the Doji's little RSI divergence there. There's no MACD divergence here, so my hope is even if this gets a little pullback here, it'll go up again and at least tag that 3,000 area. Next, Charber 75. Here's a chart from TradingView with some of these indicators and the DeMark. We did have a DeMark 9 on Friday, so just be aware that we have a DeMark 9, 13, 9 combo. So could be an area for a pullback perhaps. Moving average ribbon's pretty wide here, so just be aware of that. Next, Charber 76. Here's a chart of gold showing this potential wave count, this 3, 4, 5. Like I said, we are in the midst of this wave 5, so that's one thing just to be aware of. Once this ends, we're eventually going to have a bigger correction. But I have an idea what this might be, so let's take a look at the next charts. So Charber 77, here's the monthly view of gold. So here I changed this up a bit. First off, this chart's been here for a while. Beautiful saucer bottom back here before 2020, then an ascending triangle here, cup and handle like pattern. But here we've been marking this as a wave 3 of 5. But this pullback here is a wave 4. To me, that may be a little bit time-wise short for this to be a wave 4 to this degree. So what I'm thinking maybe is this is still a major wave 3 of this. So you got a wave 1, 2, 3. So I'm thinking once this tops, this will be a 3. Then we get our bigger fourth wave pullback, major wave pullback in a wave 4 parentheses. Then we get a new rally in a wave 5. So we'll see. Just an option. Charber 78, here's some fib projections. You can see there's also a fib projection up at 32.79. It's a 3.618 fib. Charber 79, here's silver, weekly view, up 0.5% for the week. And Charber 80, here's the daily view of silver. Again, it held that demand zone. You could see last week stalling at that recent lower high from December. Not surprising, but forms a higher low here, then it could do another shot. So as long as it forms a higher low here, stays above this broken down trend line, it looks good. Here's a 60-minute view of the SLV ETF. As you can see, this area was resistance, broke through that, then this became resistance and then support. So this is potential support here. We'll see if it can rally off that on Monday. Looking at the bigger picture charts, here's the monthly view of silver. Again, we broke out of this monthly coil back in early March of last year, which I pointed out. So far, we've been stalling at that first supply zone. But over time, guys, I think we'll make it to the next supply zone here in the 40s and eventually new all-time highs. Here's the bigger picture chart going back to the 1970s. Again, we've been struggling around the supply zone, but you can see silver's tagged that $50 area twice in the last 45 years. I think it'll tag that again. So that's why I really like silver for a percentage. Silver has a chance for a much larger percentage move than gold. Next, some other things. Here's platinum, and then I still plan to do an individual video on platinum, but platinum to me, it's extremely oversold relative to gold. Here's the weekly chart down 2% off this little intercoil trend line, but I like this longer term, another macro call. Chart 85, here's the monthly chart. You can see the coil there. Again, I have both bullish and bearish labeling here, red and green. I favor the bullish count. Still in the coil though. Chart 86, here's the platinum gold ratio, which is at 0.35. Again, this is super buried. Platinum is the most oversold relative to gold it's ever been. And the fundamental reasons, platinum has a lot of them where it's 30 times rarer than gold. The demand is now higher for platinum than the supply. About 30% of the mines have shuttered because it costs them more to mine platinum out of the ground than they make. So all those factors are eventually going to lead to a supply and demand issue to push platinum higher. Next, chart 87, here's GDX. So GDX has had a perfect ABC pullback off the October highs. Nice rally, even took out that 61 fib. It is a bit overbought here. You can see the RSI 14. So may need to pull back here a little bit in the short term. Chart 88, and here's another reason why. Here's a trading view chart with some of these indicators. So we have a DeMark 9, so a 9-13-9 combo as of Friday. So be aware of that. Some individual names I've had in my newsletter as ideas. Here's AEM. Was a beautiful coil pattern I pointed out 3 weeks ago. Hell of a move. Hope you took it. And of course, it was a great move out of that big coil pattern in March of last year when I first pointed it out. But you had a really nice coil here recently. Chart 90, here's the daily view of the coil. Again, nice move out of that. Chart 91, here's KGC. Really nice move here out of this rectangle pattern as well. Other ideas, chart 92, MTA was a long idea from a couple weeks ago. Nice little pattern. It's been a nice little percentage move here. Chart 93, JVA coffee holding. This was a recent long idea of ours. It's been a really nice trader. 60-minute chart has a really tight coil, good volume patterns, one to watch for Monday. AMD, just looking at this one for the heck of it. I'm not buying this at this time, but it had earnings a week ago. It's had a 50% correction from the highs in March of last year. It's now down to a big weekly demand zone. Could be an area to watch, but again, with these, you need trigger of some sort. Again, just because the newsletter's quite long here and we got the Super Bowl, I didn't look for any other ideas. I'll do that later and post them on our trading community. All right, guys, that does it. Happy Super Bowl weekend. Hope you guys have some stuff planned, and we'll see what happens this coming week. Steve Nelson gets back this evening. Take care.